Hello there, Salim Omar here from CPA Marketing Genius. Welcome to another episode. I've got a special guest. His name is Rick Denon. He oversees nearly 12 billion, and that's a B, in assets, $12 billion in assets and 400 employees. He leads the commercial growth strategy, including expansion of customized lending offerings and services. He's a CPA, just like you and me. Been in business for many years, former senior manager at Deloitte. Rick, welcome.
Thank you for having me. Appreciate it.
Great.
Appreciate the opportunity.
Yeah, great to have you. And I've invited my Chief Operating Officer, Rod, who's been active in the M&A space here as well. Rod, welcome, man.
Thank you for having me, Salim. Look forward to it.
Great. Let's dive right in, Rick. Share with us your backstory.
Backstory is I'm from Indiana. Been in Indiana pretty much all my life, but backstory is my father was a CPA as well. Grew up in Pennsylvania and came to teach at Ball State in accounting, and but he was a CPA, and so for me, growing up through high school and college, always was pretty strong in math. So focused in accounting, graduated in accounting, and immediately went to work for a public accounting firm. I did that for about 12 years. I stepped out for a period of time to work for a client and then jumped back in to public accounting until about 2000 when I left to go work for a VC firm, in that, .com era. And, it was a good move, to be honest with you. I enjoyed the VC side of it, but I did that for 3 years prior to starting Oak Street Funding.
So VC firm for several years, and then you said, you know what, I'm going to do my own thing.
Yeah. It was, it's one of those things where you take a step back and you look at an opportunity and you say, okay, well, why not go do that yourself? And, it came down to, as in a lot of situations, it comes down to, do you have the capital to go do that? I think I had 3 children, 3 young boys at the time, and a wife, lovely wife that, you got to continue to support. So you got that pulling on you a little bit. But if there was ever a time to do it, I would think that would be the case. And so kind of embarked down that road and went out and tried to raise $2.5 million to start the business, and went and immediately got a $15 million line of credit. And so, when you're a finance company, you have roughly 17 million then of lending capacity, so to speak. And that's how it started, and then it just kind of gravitated from that with the next level of equity, the next higher level of debt, until we finally sold the business in 2015. And at the time, we probably had, I'm going to guess, 50 million of equity and roughly 400 million in lines of credit.
What target markets or niches does Oak Street Funding and now First Financial Bank work with?
So Oak Street Funding is kind of the national platforms for the bank, and it really deals with intangible based, type recurring revenue stream, asset classes. So we started with the insurance industry and developed actuarial models for every product and carrier combination that exists that really just predicted the future commission stream of an insurance agent. And so we started, small again. You grow in size from 5 million to 10 million to $20 million type loans. But we developed in the insurance space. Soon after the bank bought us, we expanded into registered investment advisors. Then we extended into, as we saw that in a great market, knowing what CPAs do. And understanding the balance sheet of a CPA, it comes down to those recurring revenue streams, whether it be, audit, tax, consulting, but understanding those and what are some of the dependent variables that would impact, both positively and negatively, kind of the persistency and the maintenance of that book and the revenue stream. And it really is just a matter of developing those models and underwriting matching that with the underwriting criteria to put together, different loan programs. So we also, inside of that, do some, inside of Oak Street, we have another niche of subprime auto finance companies, which kind of goes back to my days at Deloitte, where I used to audit a lot of subprime finance companies and actually did securitization consulting, which then leads to the final segment of Oak Street, which is we do a lot of backup servicing for kind of niche loan portfolios that exist inside of larger banks. We act as backup servicer on securitized assets and portfolios for some niche companies. And that's worked out, pretty well for us. So that's Oak Street. There's another company within the national platform called First Franchise Capital Corp that does quick serve restaurants, in some very targeted concepts that we have. And again, have certain criteria on what we're looking for in the type of operator. We have a portfolio of quick serve restaurants that, that go across the United States. Inside of the bank are, it's a commercial bank, Midwestern commercial bank with a footprint of, Indiana, Ohio, Kentucky, and Illinois. It's about a $17 billion, 160-year-old public company that's based out of Cincinnati. So, being in charge of the commercial side of that, we've got our traditional C&I stuff. We have a business capital group. We've got treasury underneath us, a foreign exchange business, equipment finance lending, your traditional commercial products that would exist. And when we're in, here in Indiana, you get a lot of middle market manufacturing, you get some service industry, healthcare. And then we've got a pretty large real estate portfolio, as I think every bank does. So, traditional commercial bank type product exists inside there.
Very impressive background, Rick. I mean, from, starting as a CPA, working in public accounting, and then where you're at, overseeing 12 billion in assets and 400 employees. That's pretty cool, man.
Yeah, I'll tell you what, it's been a lot of fun. And it really has come down to, it's not me. We've got 80 people here at Oak Street now, and a lot of them been with us for, the entire tenure of the business. And having a wonderful team that can, have the same vision, build the organization, build the infrastructure, really drive value. I'm truly blessed to have the people that we have in this organization. And when we sold in 2015, we had 21 offers for this business. So it really allowed us to be selective on who we wanted to sell to carry on that type of culture, to carry on, kind of the mission of the organization. And it's worked out, still being a part of the bank and me, spending more and more time at the bank. You can tell that the cultures were aligned, and that it really has turned out to be a tremendous partnership and really great people there as well.
Yeah. What trend do you see developing in the M&A space for accounting firms?
Well, I think that, you always take a look at the demographics that exist, okay, on the ownership base. And I think the demographics are such that, you're looking at an aging partnership group. And I tell you what, a lot of times, as I think through the last, say, 30 years, there were times when the accounting firms had a tough time recruiting people. And I almost think that's going to get better. And I'll touch on that in a second. But, there's different age bands within the last 30 years where I think you've got, a good solid base of people. And I think there's times where that base has been short. And so in certain situations, if they haven't focused on a good pyramid and really training the younger generation, there might be gaps in that, hierarchy within the organization that you really have to help make, a good, profitable, effective operating, CPA firm. So, the reason I think, maybe some of the headcount will be strong for a while is I think we're heading into a time where there might be a recessionary period with these rising interest rates, with the cost of energy and the way that inflation is increasing. And as I've told my children, none of them listened to me and went into the accounting profession, but there's always going to be jobs in accounting. In the good times and in the bad, there's going to be jobs. And so if you think about maybe the next couple of years where the economy may be changing a little bit over where it's been, the last, since 2000 and maybe 11 or 12, with the mortgage problems that we had, I think it's going to be a time where people can balance remote work environments, have good compensation, have a steady job. And I think the recruiting will be a little bit easier over the next couple of years, starting next year, maybe not right now. I think there's just a whole lot going on, I think, with this return to work environment after the pandemic.
Rick, quick question on that. As you're seeing the acquisitions go, who is buying the firms? Because as we talked about, there's a graying of that market segment. Who's buying those small to mid-size accounting firms?
You see a little bit of just the consolidation, in my opinion, between two firms. You see some of that. I think what you see more consistently is somebody who's got a vision that says, we can aggregate, 5 or 10 firms, and we can share resources, because the work can be done anywhere, but we can share resources and have one back office. So our bottom line, our margins are going to be a little bit higher. And then to be able to do that, you got to have capital again. And I think the amount of capital in the markets today is probably at an all-time high. When you looked at the amount of capital raised even during 20 and 21, I mean, there were some record numbers. When you look at M&A in some spaces like insurance and the advisory space, they're at record numbers. And I think that has a lot to do with the amount of capital chasing deals. And I think they can look at these businesses and say, you know what, this is a recurring revenue stream. It is predictable. We know how to grow it and manage it. We need to have the right people and, a good strategy, and we can go, figure out how to make money on it.
Thank you. I appreciate that, because that's been a lot of who's making the deals if it's graying out. So thank you very much.
Right.
How should, so if an accounting firm is looking to grow through acquisition, Rick, how can they better prepare themselves? And maybe that acquisition is, they're 6 months away or a year or 3 years. What are some of the things that they should be doing or can be doing so that they're ready to acquire a firm without difficulties?
Well, I don't think this is just part of kind of an acquisition strategy, but I think management teams need to be very true to their skill sets. What are their core competencies? What do they do well? What do they not do well? And they need to be true to that. And they need to understand it and accept it. As far as preparing for those acquisitions, then, as I said earlier, I think, human capital is the most important thing, certainly within the CPA profession. Having the right human capital, the right management team, alignment on those strategies is critical to do that. The next step in doing that, to me, would be define who you want to be in the future. So you've got a good assessment of who you are today, your strengths and weaknesses, and then say, okay, do I want to grow my compliance practice? Do I want to grow my attestation practice? Do I want to grow my consulting practice? Geographically, where do I want to go? And I would be then very intentional about who you're targeting. Okay, so if it's somebody within 100 miles, okay, if it's somebody that has a good, strong tax practice because yours is weak, or is it, hey, ours is strong, we know we're really good at it, we want to continue with tax. Go out and do the research. Go to networking events, be a part of the state CPA societies and start networking that way, and be very targeted and send letters to say, hey, this is who we are. This is what we're trying to accomplish. If you have interest, let me know. And I'm going to tell you, those types of letters sit in somebody's drawer until there's an event, whether it's a liquidity event that somebody wants, a partner want in or out, whether it's a health issue, something's going to happen that they can say, you know what, who was that I just got a letter from, not too long ago. And it's probably not going to result in, 10 leads that you can call and get term sheets out to do an acquisition, but it's going to result, I think, in a starting off with the correct alignment, and then, providing lead flow as those things occur, as something would occur. And so you got to be intentional about that. I think there's also some good brokers, that would be out there that know the markets, and you can be very definitive with them, and just geographic, how you're trying to grow.
Yeah, makes a lot of sense. What are some mistakes that you've seen in your career in the M&A space that buyers and sellers make?
Emotional, where somebody gets into a deal and they see all the yellow flags being thrown on why this deal wouldn't be good. We don't want you to talk to our staff until the deal's done. We don't want you talking to our customers till the deal's done. I'm moving to Florida and I'm going to be done as soon as I want 100% of my cash up front. Okay. No employment agreements that exist. High turnover in employees or customer base. Changes in profitability. When most people know how to operate a firm, and especially if they're looking for acquisition. So when you start seeing some of those things, maybe you didn't see them from the initial, somebody wrote you back and said, I have an interest. But when you start asking some of those probing questions, to ignore them and just say, we need to do the deal. There's that one client in there that I want to get. You know what? Stick true to what your goals are. Stick true to what your culture is, and make sure you're doing your due diligence. Hire good lawyers that are going to structure the deal. They're going to create indemnifications. They're going to put retention, thresholds in there for your client bases. They're going to structure it on an earn out so that you can transition customers. When you start seeing opposites of those signs, close the book and go find the next deal.
Yeah, good stuff, man. Valuable information. I want to ask you, Rod, the same question from your experience in the M&A space. What are some mistakes you've seen, buyers and sellers make, and with the hope that they can be avoided, listeners can avoid them when they're a buyer or a seller.
And really, I'm gonna continue on with Rick's, because in my experience, I've seen emotion. You get into a deal frenzy, especially ownership wants to make the deal, and they're willing to look past things. A big one I saw that Rick mentioned was not letting an acquirer speak to customers or employees. Those are two big red flags right out of the gate. And I've seen a deal where that literally cost a buyer almost a third of the cash stream, because they had one major customer and they're like, we don't want you to talk to this customer until we're done. We don't want to spook them. And we brought it up as an issue. Clients waved us off and said, no, I want this deal. That's perfect. They've been a customer of the target for 18 years. That should be your first thing, is if it's been that long, they may be looking, or, you want to. No sooner they close that deal and that client that big client that was a third of their revenue tendered a sever notice within the first 12 months. So the revenue stream was dropped by almost a third. First of all, I didn't like the idea that a third of the revenue was tied up in one major client, but
That's a great example, Rob.
Yeah, you got to really look at those type of things. And now we know why. And they said, if we'd have talked to that client, they said, we've been evaluating. I mean, they told us that as I came in, think that they've been evaluating whether they were going to move on for the last year. And that seller knew that. I mean, we advised them to actually go back and do bad faith on the seller, just because they were well aware that
was
there was that risk.
Some way.
Yeah. So it's one of those things, but it was all emotion. That client, that buyer wanted to close that deal and would not be willing. You got to be willing to walk away at any point, right up to signing the document sometimes if something comes up.
And that's where a good lawyer with the proper structure and somebody that understands what a CPA firm is about makes a whole lot of sense. If there was a retention agreement in place, then the purchase price gets adjusted. They don't really have a whole lot of risk on the downside perspective. And, you're going to really flush out some, unethical sellers if they're unwilling to do some of those things. Don't ignore them.
This has been really good. Time's flying. I've got a couple more questions. Rick, what do you look for as a company when you're financing a deal? What's your sweet spot? What type of acquisitions are in your sweet spot? Dollar amount or types of practices or geographically where they're located?
I would say not so much geographic, but when you think about what we just talked about here on potentials for things that could go bad, what I look for, number one, is a good solid management team, okay, and a good structure. I mean, it's easy if you've got a nice growing CPA firm that wants to add 2 or 3 partners and we're going to finance that. Like, that's an easy one, right? People have been there a long time. There's really nothing happening other than good things, promotion, growth. And so that's a perfect, love those types of deals where you see, success occurring, I would say, amongst all of the owners. The other type of success is when you see, maybe 2 firms coming together. They've known each other for years. And it's a good cultural fit. Geographically, you can see overlaps in industries, or, they've really identified, maybe it's technology that one has that one doesn't have. And when you put them together, it's, the synergy of, 1 and 1 is, 5. And it's fun to see those succeed. But I would see the least amount of risk you have is when you have like a partner buy-in, type opportunity that we frequently get.
Any particular revenue size practices or loan amount practices that you work with?
It's interesting because, kind of to your point you talked about, Rob, with concentrations, it's almost the opposite. It's the same thing, but it's the opposite, because I don't want a firm that's got $500,000 in revenue with one partner. Okay. That person has all the relationships and they have 100% ownership. So if something happens in their life, I mean, health issues, divorce, decide they don't want to do it anymore, like, the business is gone. Whereas if you had 500,000 in a 10-person shop, so you got 5 million in revenue, you got less concentration. So if one partner leaves, you got 9 that are all incented to figure out how to maintain that $500,000 book. So, we've kind of learned as we've gone along, but clearly we think that a larger, more diverse firm is obvious, it's going to have less risk to us. Instead of doing, $500,000 loans, I'd rather do one loan for 2.5 if my math is working today.
Makes sense. Yeah. Are you of the opinion, belief that sellers should stay in the practice, or the sooner they leave, the better it is, and for them to get 100% of their money upfront, or shortly after the closing, or over a 3 or 5 year period of time?
From a lending perspective, there's only one way we would do a deal like that. And it's not going to be for 100%, purchase price paid on day one, seller exits. We're happy to finance a deal like that, but I'm not going to be financing 100% of the cost. So the seller may want to do that, and they may have to bring, a significant portion of that price in equity, which isn't beneficial for them. So in that regard, I'm kind of aligned with the buyer to say, you know what, make sure you do an earnout. It's less risk for you, less capital out the door on day one. Make sure you've got alignment on your structure, and there's going to be good transition with the customer base. And then, we're even happy to fund the earnout over years 1, 2, and 3. But it's got to be based on an effective transition of those relationships. So no, there's only one way I would consider doing these transactions.
Yeah, that's awesome. What multiples have you seen in the accounting space?
They're growing. I would say early on, I've seen, the smaller firms, I think, are going to be sometimes a multiple of revenue, whereas your larger firms is more, EBITDA type based. So you're going to look at that, and you're going to see multiples, which, I would say lately are growing, but you're going to see a 6 to 8, maybe a 9. And I suspect that those numbers, because, we talked earlier about the amount of capital that's in play right now, I suspect those multiples are going to increase, because I can't see a whole lot of aggregators leaving. It's not like, hey, we're just going to pack it up. There wasn't, it's not the largest market in the world, but I think it's a really good market, and one that could afford some consolidation. And therefore, I think those multiples will increase over time. And the other thing to think about too, we talked about demographics, but I also think COVID caused a lot of opportunity for these firms to be more profitable. So somebody that's at that higher age bracket that's thought about retirement, times are good, rates are low, capital's available. I can sell my firm today. My margins went from, 40% to 60% because we sat at home. We didn't have to travel. We were able to pass any costs, and we increased our fees. Therefore, there's never been a time that's been more profitable. So you might see people exiting on those, but
yeah, good stuff, man. This is amazing, Rick. Greatly appreciate it. I've just got 2 more questions to ask you. One is really, and Rod, chime in if you've got 1 or 2 questions for Rick. What's a question, Rod? If you've got a question, why don't you ask, and then I'll kind of follow up with a couple of questions that I've got.
We talked about the aggregation. I mean, what do you see being the kind of steady state firm size when the aggregators get done? Is it you see it as that 8, 10, 20 partner firm, or is it going to be moving to trying to becoming a mid-regional, or where do you see that? Where do you see the market heading in that?
Well, I would say, most of the aggregators are sponsor backed. That's usually where they're getting their money from.
Mm-hmm.
And so if you stick with that on a 5-year type horizon, and let's say they're doing 4 transactions a year, right? Mm-hmm. You're probably not going to get 4 done the first year, but you're going to get, what that be, 16, 18 type deals that you can put in the mix. And obviously those will vary in size, but I think it really is going to come back to, are you getting, $10 million to do an aggregation that you're going to then leverage up with $10 or $20 million of debt? Or, with the same type of metrics there, are you getting 25 million, 50 million, 100 million? what are you getting that you're going to be able to take, and then what's your dry powder to go to the market with and get deals done with. So I think it's probably more the question there, Rob, is, how much capital are you getting to start with and play with? And, it might be from one aggregator to another PE sponsor that, hey, you guys, we did 16 transactions and we did, $20 million of enterprise value deals. Well, here's, you did it, you were successful. The next PE sponsor is going to say, here's 50 million or 100 million. Let's go do it again, continue to consolidate.
I can see that with that. And that makes a lot of sense. I appreciate, thank you for that.
Yeah.
Very good, Rick. What's a question we should have asked you and we didn't?
Let me think about that. I would say probably two things. How does technology play into the space? And how do you best position your company? Is it better to have, a heavier weighting on consulting, tax, or, attestation type work? And maybe I'll turn it to you, Rob. You've done some M&A. If I threw that question at you to say, how would you best position the company? Would you want more of one or the other, or a balance?
I tell you, from a traditional standpoint, especially with the markets. I use one that if you're going for, say, traditional manufacturers, or that's your client base, you would want to have that attest practice as well, because most of those businesses have a strong mix of consulting, compliance, and attestation. So to really service that market, certain other ones you could probably weight your focus more to consulting and tax in the industries that maybe have a less focused attestation requirement. But if you're going into a broad base, especially ones that touch manufacturing, I would want to have a balanced firm just to be able to service that client base, because otherwise you're going to be having to part out pieces of engagements, because as you know, a manufacturer is going to come in and say, well, I've got an asset-based line of credit of 75 million that I need an audit for, and you're going to need to be able to service that as well as do the compliance and the consulting. So I would say it may be driven by the client base, but overall I'd lean toward a balanced firm more than like a boutique shop. I think it limits your opportunities a little bit.
Yeah, one thing I might add to that, would be, I suspect the margins on the attestation work have declined over the last, if you look at a trend over the last 10 or 20 years, even though I think they spiked, and improved during the pandemic, versus consulting, which has a super high margin, but is probably less recurring in nature. You've got to find that balance. If you can show you've got consistent consulting revenue at high margins, and it's different in a good client base, and you've got audit and tax on the side, that's a pretty powerful, argument to drive a good multiple on your transaction.
Especially because a lot of times audit is somewhat the loss leader. I don't want to call it the loss leader, but coming out of Big Four, that was kind of the case a lot of times. Was audit was what got consulting and tax in the door, and a lot.
Well, I tell you, I did a lot of sales at Deloitte, and I wouldn't leave the office without having a tax person with me. Whether it was a corporate where we've analyzed returns and we've got cost saving opportunities, or it's like a state and local property tax type person. But if you walk in the door and you can say, I can save you $6 million in tax, we've got a solution for you. Like, who wouldn't sign up for that? And then I was on the audit side coming in and just kind of cleaning things up, and doing the audit work. But it was so much easier to sell tax work than it is, audit work.
Audit's a necessary evil. It's one of the things that they're made to have. They want to have the consulting. They want to have the tax.
Yeah. And you saw, I think some of the Big Four, they're spinning off their consulting practices and pushing those out. And I think, partners complaining that, hey, you guys are dragging us down. Audit and tax saying, hey, let's sell them off, take a big multiple on this consulting group. So, you had all those dynamics. Then you had Anderson, kind of winding down from the Enron and energy stuff. So a lot of different things have happened in my career on it. I'll still go back and say, great place to start a career. Anybody that's getting into business, to have an understanding that you get from financial statements, tax returns, that will never, ever, in your business career be wasted time.
Agreed.
This has been amazing. Thank you so much. If listeners want to reach out to you, what's the best way for them to do that?
Our website, oakstreetfunding.com, is probably the easiest way. And then you could click management and you'll get direct access to me with phone numbers and emails. That would be great. But, I want to thank you guys as well for being in the profession. I certainly appreciated the time with you. Great questions, great discussion.
Awesome. Good stuff. Thanks, Rick. Thanks, Rod. You guys take care.
See ya.